So guys, here on the channel, we talk a lot about which stocks to buy and what to look for in an investment. But today, I want to flip the script and shed some light on the things that you want to avoid when hunting down your next dividend stock. In this video, we'll take a look at 5 warning signs that will help you know if the dividend stock you're about to buy is a big mistake. And to really help it hit home, I'll share a real-world example for each one. Now, getting into the first warning sign, if you see a company with declining or stagnant sales, that should definitely be a big red flag. Revenue is the lifeblood of any business, and without consistent sales growth, there's really only so long that a company can keep from going downhill. With that said, it is normal for a business to hit a rough patch every once in a while. Growth is never so linear that it's always just straight up and to the right. But when a company's revenue is shrinking year after year, like what we're seeing here with Whirlpool, that's a sign of a much bigger problem. If we look at the revenue chart right here, we can see that sales have been trending down pretty much every single year since 2017. They have really dropped off, which tells us that for some reason or another, people are just not as interested in buying products from Whirlpool. And due to the length of this decline, 7 or 8 steady years there, this seems like more than just a bump in the road for the company. With that said though, to their credit, I will say the company has still managed to grow free cash flow here pretty well, but really that can only last for so long. There's only so much cost cutting and efficiencies you can squeeze out before there's nothing left to cut. And also for Whirlpool, we can see that the free cash flow has also dropped off here these last couple of years. Long story short though, going back to the revenue, you want to invest in companies that are growing their sales and increasing their customer base every year, not the other way around. Anyway, getting into the second warning sign, this ties into the first one except for the fact that we're talking about declining earnings and free cash flow instead of declining revenue, but either way, none of it's good. At the end of the day, dividends are funded by the actual cash that's being generated by the business, so if profits and free cash flow are falling, it calls into question the safety of the dividend. And as we can see here, Intel is a textbook example of falling earnings and free cash flow. Over the last few years, as we can see here, the earnings per share and the free cash flow per share have really fallen off a cliff to the point where the company's actually losing money as the business has struggled to play catch up in the cutthroat semiconductor industry. Now, eventually these losses forced their hand, and in 2023, Intel slashed the dividend by more than 65%, and I'm sad to say that I was on the receiving end of that cut. That one definitely hurt. But then by late 2024, the dividend situation got even worse, and they ended up suspending the dividend altogether. Even though it's always sad to see a company cut their dividend, the move for Intel definitely made sense. I mean, if the company isn't generating any profits or free cash flow, there's no way that it can possibly afford to keep paying dividends to shareholders. It's kind of like cutting off the arm to save the body. Nonetheless, though, you want to try to avoid companies that find themselves in that position. Just like with the revenue, you want to invest in companies that are able to grow their profits and grow their free cash flow over time. Anyway, moving on to the third warning sign. Now we're moving away from the absolute numbers and talking about the margins, but the same rules still apply here. Margins can tell you a lot about the underlying health of the business, and if margins are heading in the wrong direction, meaning if margins are going down, it can signal all sorts of bad news. When margins are falling, it usually means costs are rising faster than revenue, or the company is being forced to sell their products for lower prices, which indicates that the company might not have any pricing power, which also could indicate that the company has no moat, and that definitely doesn't bode well for the dividend, and it also isn't good for the long-term outlook of the company. Fat Brands over here is probably the poster child for declining margins. I mean, I love me some Fat Burger, don't get me wrong, but the company's gross margins have definitely suffered, guys, as their cost of goods sold continues to eat up more and more of their revenue. Look at this. It's crazy. The margins have gone from pretty much 100% all the way down to 25% here in 2024. And with that, beyond the gross margins, the net profit margin and the free cash flow margin have declined to the point where they are in negative territory, which kind of ties back to point number 2. If the margins there are negative, it means the company is losing money, kind of like what we saw with Intel. The earnings per share are negative and the free cash flow per share has also gone negative, which brings us back to the earlier point. If the company's not making money, there's no way it can sustain a dividend. And unfortunately, that has proven to be true with Fat Brands. Earlier this year, the company suspended their dividend, which really is no surprise considering the free cash flow has been negative since 2020. But even beyond the dividend, I mean, all these things here are indicative of a low quality business. And why would you want to invest in a company whose financial situation only seems to deteriorate? Great businesses don't do that. Great businesses only get better with time, and you only want to invest in great businesses. Anyway, now moving on to the fourth warning sign. As a dividend investor, you're probably already very familiar with the payout ratio, but in case this is is your first time hearing about it, the payout ratio essentially tells you how much of a company's net income or free cash flow they are paying out in dividends. A rising payout ratio means that the company is paying out more and more of its earnings or its free cash flow to maintain the dividend, and there are two reasons this can happen. Either the earnings and free cash flow are declining, like what we saw earlier with Intel or with fat brands, or the dividend is growing faster than the earnings and free cash flow. Either way, a rising payout ratio isn't sustainable. And as an example, we can look here at Campbell's Soup Company, CPB, and I used to love this company. Some of you guys will probably remember if you've been watching the channel for a long time. I actually used to own this company in my portfolio back in the day, and fortunately, I did make a little bit of money on it. Not too much, but this was one of my earlier positions. This is kind of a blast from the past for me. But looking at the payout ratios, the situation is not looking good. Back in 2020, the payout ratio was only like 26%, but if we fast forward to this prior year, 2024, it had soared up to almost 80%. And the same is true here if we look at the free cash flow payout ratio. Back in 2020, it was about 38.5%, and in 2024, it has jumped up to 66.5%. And you know what? In both cases, there is still some wiggle room here. I mean, even with a 66.5% payout ratio, they're not throwing out all of their free cash flow to the dividend, and here with the earnings payout ratio, you know, they're still keeping 20% of their earnings. But really the concerning thing here is the trend. You know, if it keeps going up and to the right in both departments, eventually these payout ratios will reach 100% or more. And if that happens, it's just not going to be sustainable. It's not hard to imagine a scenario in which Campbell's Soup Company would have no other option than to cut the dividend. So that's definitely one thing you want to look out for. Anyway, now sticking to the topic of dividend cuts, this is going to bring us to the fifth warning sign, and this one is very straightforward. As a dividend investor, obviously you want to invest in companies that can pay you more income over the years, not less, and there are quite a handful of companies out there that have a pretty bad track record of reducing their dividend payments again and again and again. Orchid Island Capital here, ORC, is a fantastic example of this. I see this one all the time in the comments. If I ask, you know, what people bought this week or what people are looking at, ORC is very common to see. A lot of people are buying this stock, and it's no surprise. People get reeled in by the stock's super high dividend yield. It's consistently over double digits. In the trailing 12 months, it's about 20.5%. So obviously a very tantalizing dividend yield, but unfortunately, that yield is so tantalizing that it blinds investors from the fact that ORC has historically cut its dividend almost every single year over the last decade. As we can see, this is the opposite of what you want out of your investments. Like I said, you want to invest in companies that will grow your income over the years. You want this to go up and to the right. Now, for a lot of investors, it can be hard to look beyond the dividend yield. I understand that, especially when you're getting one as high as what ORC is offering, you know, 20.5%. But you can't be reeled in by that. There are so many other things that you need to look at beyond just the dividend yield. And I don't care how high the yield is. Like I said earlier, you want to invest in companies or ETFs that will grow your income over time, not shrink it. So needless to say, I will not be buying ORC anytime soon. And in this next video right over here, I'm telling you about a few more stocks that I am most definitely staying away from, and I think you should too. In my opinion, these three stocks are on the brink of cutting their dividends. The red flags are piling up, and if you own any of these, you'll definitely want to take a closer look. So click right over here to check those out, and I'll see you in the next one.